Secondly, yes, it is one of the big problem of the Eurozone right now, the fact that there is no common capital markets across the region. And this is contributing to the reliance of the non-financial private sector on bank funding, which often stifle credit creation across the region, also stifles the ability of firm to be able to raise capital in the equity market. So this creates a much more rigid system in Europe that is weighing on growth. And I believe that Christine Lagarde is indeed right that this would be a very positive development for the Eurozone if it ever were to be implemented.
At the end of her speech, she acknowledged that some will argue that unless we start issuing common EU bonds that will ultimately constitute a European safe asset and parallel U.S. Treasury bonds, this project will not succeed. Do you think that's true? In order to see this project come to light in a successful way, we're going to need to head down the joint issuance route.
Yes, that's correct. Ultimately, it will be an important step, if not the paramount step, to achieve a true capital market union in the Eurozone. However, this will be the most challenging steps. It's involve governments ultimately giving up some of their sovereignty, which, as we know, is something always very, very difficult across the world, and it's true as well in Europe. So this will be ultimately probably where the project will break down the road, is that if we cannot get to the point of the issuance of a common bond. And also a euro bond will go a long way into solving the big problem that exists at the government level, which is that Italy, Germany, France all borrow at different rates, all have their own risk, which creates a further fragmentation of the capital markets in the Eurozone.
Very big long-term question for the Eurozone, and one that seems to be perennial. Let's go back to what you were saying about most businesses in Europe being reliant on bank funding to get access to funding. Very different model from what you have in the US, where of course you do have a flourishing capital markets system. The ECB have tightened rates quite dramatically. There has been, a steady period of monetary tightening that has been introduced on the back of these rate hikes. To what extent is that actually affecting today's availability of credit and desire to borrow out of those institutions, companies, corporates that would typically go to the banks for their funding?
Yeah, the ECB Banks Lending Survey provide a lot of answers to this question. What we're seeing there is that from the perspective of willingness to lend by the banks, credit standards have been tightened massively for both households and for corporations. On the other side of the equation, we can see that the demand for credit has collapsed by firms. And one of the main reasons that companies cite to justify decreasing their borrowing needs or demands at the very least is the fact that interest rates are very elevated. So this is definitely starting to have an impact. And we're also seeing it in a more concrete fashion when we look at credit flows in the Eurozone, which have really collapsed relative to where we were 2 years ago. And by many metrics, credit borrowings by firms is actually in negative territory, i.e. firms are repaying their debt right now. So it shows clearly that monetary policy in Europe is having an impact through the credit channel and will ultimately lead to a recession in the Eurozone.
So that brings me to my next question. The market has started to price in the first rate cut out of the ECB as soon as April of next year. Do you agree with that timeline? And how do you think the economy is going to be looking at that point?
So April might be a bit early. But ultimately, we're really talking about like a month or two here. The reason why that's the case is that the ECB seems to be looking in the rearview mirror in terms of the main variable it is tracking to decide the direction of policy. We know core CPI is important, and core CPI is slowing down significantly in the Eurozone, but the ECB is also paying a lot of attention to wages, and wage growth remains elevated. But wage growth is an extremely lagging indicator. And this focus on this variable means that there is an elevated odd that the ECB starts cutting rates a little bit too late. relative to where the economic environment is. And we see, based on dynamics in the global economy, based on dynamics within the Eurozone, such as where interest payments are likely to be next year, that the Eurozone will most likely be in recession by the summer. But the ECB is unlikely to cut rates preemptively and will wait till we see more deterioration in the labor market.